Hey guys, what's up? Welcome back to another video. In this video, I'm going to be talking about a stock that recently announced earnings in the fourth quarter of 2022, and that stock is Verizon. And we can see over the last year, Verizon has been having an absolutely atrocious year. They're down around 27% over the last year in the same time period that the S&P 500 is down only 7%. So they are underperforming the market over the last year. And so we're going to see if this really sharp decline in the share price is meaning that Verizon is presenting a good buying opportunity at the current share price. We're also going to look into some of the recent news that's come out around Verizon, and then also compare them with some of the other companies we've looked at in our past videos. And so right here in this article, we can see they point out that a lot of Verizon's growth in the fourth quarter in terms of subscription growth came through generous wireless promotions, but they're starting to phase those out because they don't really want to continue to give away subscriptions to their customers. And so right here, they point out that over the holiday season, they gained more phone and internet subscribers. They've had difficulties in past quarters with basically growing their subscription count due to price hikes. And so as a result, in the fourth quarter, Verizon added 217,000 postpaid net phone subscribers, which is a metric that is used in this industry with other companies like T-Mobile and AT&T to measure success. But the majority of those customers were business customers, whereas the consumers, commercial consumers, only amounted to 41,000 net subscribers. They pointed out that this turnaround was driven by generous promotions and trade-in offers, but these financial incentives are going to start going away because they don't believe that they are sustainable for the industry in the long run. On top of that, they're planning in 2023 on extending their 5G coverage from 200 million people to 250 million people by the end of 2023, and that'll boost speeds from 900 megabits per second to 2.4 gigabits per second. So, and then lastly, right here, they point out that they've been launching new products such as their Verizon prepaid line to try to rival T-Mobile's Metro and AT&T's Cricket brands. So there's a lot of competition happening here in terms of trying to acquire customers, especially with the 5G race happening right now. And as a result, Verizon tried to increase their subscription count by giving away some incentives, some positive incentives, but they're going to try to phase those out now because they don't think that that is sustainable in the long run. And we're going to see how that's going to affect their business in the future. And so right here, we can see their income statement comparing 2021 to 2022. Operating revenues are up from $133 billion to $136 billion. And then we can also see that actually of this operating revenue, about 35.3 billion of it came in the fourth quarter, and that was up around 3.5% year over year for fourth quarter revenue. And then for net income, we can see that it's down from 22.6 billion to $21.7 billion. But interestingly enough, in the fourth quarter of 2022, Verizon basically reported $6.7 billion worth of net income, and fourth quarter year-over-year growth was 41.4% for their fourth quarter year-over-year growth. So their strategy to acquire new subscribers for the fourth quarter definitely worked. They had a lot of growth in the fourth quarter, but they're going to try to phase those out because they don't think that it's very sustainable. And so right here, we can see their balance sheet. Their total assets are being compared for 2021 and 2022. And during that time period, it's up from $366 billion to $379 billion. We can also see that total equity is up from $83 billion to $92 billion, with retained earnings increasing almost 10 or more than $10 billion from $71.9 billion to $82.3 billion of an increase in retained earnings. So that definitely gives them more capital to play with in terms of returning value back to shareholders. Lastly, right here, we can see their cash flow statement. Operating cash flow for 2022 was $37.1 billion, down from $39.5 billion in 2021. And then we can see in financing activities that they paid out dividends of around $10.8 billion, which is up from $10.4 billion and up from $10.2 billion in the time prior to that. So they are prioritizing returning value back to shareholders through dividend payments. And considering that they had operating cash flow of $37.1 billion and returned almost $11 billion worth of cash through dividends, it shows they were returning a pretty substantial portion of their operating cash flow right back to shareholders through cash dividends. So Definitely a good sign to see for shareholders, especially considering the fact that their stock price has declined this much. If shareholders buy into the stock at this depressed share price, they might be able to experience positive returns in the future, coupled with the strong dividend payouts that they experience by holding onto shares of Verizon. And so right here we can see this discounted cash flow model to figure out the intrinsic value per share for Verizon. Yahoo Finance, interestingly enough, estimated that Verizon's growth rate for the next 5 years will be literally less than 1%. So we'll see how that holds up as the years progress. In terms of free cash flow, we can see they had around $14 billion of free cash flow in the most recent full year, around $2.5 billion of cash on their balance sheet after subtracting debt, and 4.2 billion shares outstanding, which puts their intrinsic value per share at $35 per share, which means that at the current share price, they're not exactly trading below intrinsic value per share, but they're basically trading right next to it at around $38 per share. Also keep in mind, this intrinsic value per share is taking into account the fact that they're only going to grow at literally less than 1% per year for the next decade, compounded annually. So if they do manage to grow faster than 0.82%, so for example, if they grew by like 5%, that pushes their intrinsic value per share up higher, which would mean that they would be trading below intrinsic value right now. But obviously, at the moment, they're estimated to grow at a very low growth rate. But even with that said, they're trading pretty close to intrinsic value per share. So hopefully they are able to grow at a faster growth rate than 1% per year, because if so, that would mean that at the current share price, they could be presenting a good buying opportunity. And so on the right-hand side here, compared them to T-Mobile and AT&T in terms of financial ratios. We can see that in terms of gross profit margin and net profit, return on assets, PE ratio, and dividends per share, Verizon beats out T-Mobile and AT&T. They're trading at a way cheaper price to earnings ratio of around 7 times earnings compared to T-Mobile's 70 times earnings. AT&T isn't really profitable, so we can't really compare them in terms of profit margins and PE ratio to Verizon and T-Mobile. In terms of gross profit margin, Verizon has the highest at around 44%, but across the board, it's pretty similar, right around 42 and 44%. And then lastly, in terms of dividends per share, they are paying out a dividend of $2.58 per share, which is higher than AT&T's $1.11 per share for the most recent full year. So definitely, in terms of a competitor analysis perspective, it looks like Verizon would be the stock to buy in this industry. And now I'm going to compare them to the companies we've looked at in the last 8 videos. We can see that Verizon, in terms of share price compared to intrinsic value, actually is stealing the second place spot right behind Albertsons. It almost made it as one of the only companies on the list, coupled with Albertsons, to be trading below intrinsic value per share, but it unfortunately just did not get above that ridge. They are trading at 109% or 1.09 times intrinsic value per share at the moment. Albertsons is still the only company trading below intrinsic value per share. In terms of growth rate, Verizon's 0.82% puts them dead last, clearly. Netflix has the highest at around 16% for the next 5 years. In terms of profitability ratios, Verizon comes in right around the middle at around 44% gross profit, right behind Adobe, Microsoft, J&J, and Nike. And then in terms of net profit, they had around 15.53%, right behind Microsoft, Adobe, and Johnson & Johnson. And then lastly, with stock performance, they're the only stock on our list that actually had a negative return over the last 5 years at negative 22%. Definitely not a good sign for shareholders. Microsoft is holding a dominant first place spot at 191% return over the last 5 years. And as I touch on in every video, these companies are trading in different industries, are competing in different industries. So the financial ratios are going to be all over the place in terms of comparing them there. But this is just to compare them against each other on a video-to-video basis so we can know from a bird's eye view perspective which company we might prefer to invest in and which industry we might prefer to invest in. But in terms of comparing them to the other companies, stock performance, net profitability, gross profitability, growth rate, and intrinsic value. In terms of intrinsic value, they're doing pretty good. Growth rate, not so much. Profitability, they're doing pretty good, around middling of the pack, and then stock performance, they're doing absolutely abysmal. In the competitor analysis ratio perspective here, in terms of comparing them to T-Mobile and AT&T, other companies in their industry, they are definitely pretty dominant here, as we can see. And then in terms of intrinsic value per share, they're not trading below intrinsic value per share, but they have really low projected growth rates by Yahoo Finance. So if you play around with these ratios and set different parameters, it is possible that they could be trading below intrinsic value per share based on your own qualifications for whether or not this would make a good investment. So let me know in the comment section down below if you guys think Verizon is a good buy right now, considering the fact that their share price has declined quite a bit over the last year or so. Leave a like on the video, subscribe to the channel, and I'll see everyone in the next one.